All right, so let's get started. Let's get into it. So again, like I said, my name's Catching Rockets, Drew. I should say Drew, aka Catching Rockets, day trader, scalper. So I get in and out of trades really quickly. Tonight we're gonna run through POCs, which is point of control, volume profile, value area, what I look at when I'm trading. We're gonna briefly touch on some technical analysis, and that's if we do the full hour and a half. Again, I'll leave that up to you guys, or I guess if you're not interested in doing the full hour and a half, you can always just leave. That's at your discretion, of course. But for me personally, I think like the full hour and a half, by the time I'm done, um, and again, like I'm not when I say this, I'm not talking down to anybody. Like all of us come from different backgrounds. All of us have like our skill sets, our trading abilities. So when I say after I'm done with this, like if you follow what I'm saying, you'll be able to be consistently profitable. I'm not suggesting that you're not already consistently profitable. I'm not like all knowing or anything. You know, I can learn from everybody in this room, I'm sure. Um, and I'm sure a lot of you all have a lot of great information that you could share. So I'm just running through the information that I have that for me as a trader was like when I finally figured these things out was like the epiphany moment that took it all to the next level for me. So I'm going to start out really quick on SPY and go over just a couple of things. I might have somebody give me a ticker symbol in a little bit, and we'll just run through how I look at a chart from start to beginning. Or I'm sorry, from start to end. But so let's just hop into it. So we're looking at SPY. We're looking at it on the day chart here. How I normally will look at my charts is I go to the 30-minute, and from here, I turn on my volume profile. And a lot of people are not familiar with volume profile, and that's fine. For volume profile, there's a few places where you can find it. One of them is on Thinkorswim. The other one is in TradingView, which I'm using right now. And on TradingView, to get this indicator, it's called VPSV. You have to subscribe to TradingView. The minimum plan, it's like $14 a month or $15 a month, will give you access to this indicator. Once you have it, or sorry, once you subscribe, you would literally just search for VPSV, and it comes up here, volume profile session volume, and that's the one that you're going to want. Once you have it, you're going to want to double click on it, and you'll want to change your row size to 200 and your value area volume to 68. And I'll cover the value area volume to 68 a little bit later in this video that we're going to go through. So volume profile is a very, well, in my opinion, and I know a lot of people in like the calls options have seen me use it, where I'll call out a price on a stock like, hey, such and such is going to this price, and it will normally touch it like within pennies. That's all based on volume profile. And so with volume profile, I'm able to determine pretty much with pretty accurately where price is going to go on a stock on any given day. And I'll explain to you guys and teach you guys how to be able to do that yourself. So first thing is, what is a POC? A POC is going to be the point of control. So these red lines that are showing up on my chart, these are all POCs for each day. I'm sure you guys know, like this is one day here, one day here, one day here, one day here, another day here. And so the point of control is the area on the chart where the most trading took place on any given day. And so as the day is happening, that point will move throughout the day as the trading day happens. So like this point of control here for February 11th, when we opened up here, originally the point of control would have been up here somewhere. But then as the day went on and the stock came down here and consolidated here, and most of the price action took place in this area, the point of control would have moved and settled here. So when you chart your POCs, you want to use the 30 minute time frame, and you want to have extended trading hours on. Some people will say turn off extended trading hours. I found that with extended trading hours on, the POCs tend to get respected more often, more accurately. But then it also might just be a personal preference. You can try with both the extended trading hours on and off. So the way that you want to look at POCs is going to be you want to look at it as yourself as a excuse me. You want to look at it, think of yourself when you're sorry, I'm trying to do things and talk at the same time. Yourself as a trader, if you are buying stocks, because we can't apply this to options because of theta decay, this wouldn't be true. But say you're buying stocks and you buy a bunch of stocks here on SPY at $456, and the very next day it tanks. Now you're stuck up here with a bunch of stocks and you're in the hole. You, as a retail investor, the next time the stock price comes back up to this area, what are you going to do? Hopefully, everybody's thinking sell, because most retail investors are going to try to get out of that trade, break even, and just get their money back and move on and live to trade another day. So up here is retail buying in these areas. And you can see if we go forward to this day here, so price left here to the downside and traded sideways a bit and finally came back up to here. And when we got here, if we zoom in on this day, I guarantee you that POC is being touched like to a T. So here pre-market, doesn't really count. But once the market opens, you can see this wick barely goes through the POC and then we pull back. And then a wick goes up and touches it and pulls back. This wick goes up and touches it and pulls back. Another wick comes up and touches it and pulls back. So you can see these POCs act as support. And then when we get above them, they'll start, act as resistance. When price gets above them, they'll start acting as support. So they're very, very, very powerful. So again, retail buying up here. And then what happens down here is we have, sorry, this one's slightly off and it's going to bug my OCD. Down here, we have market makers, large institutions. They'll place, whatever, $100 million order on SPY here, and it causes price to rip up. Their orders are normally dark pool, so they're not causing the price movement, but their order coming through the dark pool will make retail go, ooh, look, looks like the market makers are bullish on SPY right now. Let me hop in. And so then we see the price rip up. And then with these guys, if they put in a $500 million order for SPY here and price takes off and they only get a partial fill, they don't chase price. They're going to leave that order down here, that limit order at whatever this price is. And the next time SPY comes down to this price, they're going to get filled more. So the very next day we see that this wick comes down, touches it, and we take off again, right? So more of their order just got filled here. And none of this is pre-planned. Like I didn't go, oh, let me look at SPY and make sure that this is going to meet my narrative for doing this class. This just happens all the time. When you guys start using POCs, if you're not already, you'll see these levels just keep getting respected over and over and over again. You can see it, this is the next day, came down and touched it and then ripped up. And then 2 days later, we come down and touch it again in pre-market and take off again. And then the third day after that, we come down and we touch it twice and rip up again. So those market makers, institutions, whatever, they're getting fills here, right? So they're also selling here because they know retail is going to be selling here. They might be, offloading shares here, but also these people that got in and they've been in the hole for a few days are getting out here as well as soon as we come back to this level. So POCs act as magnets for price. So Actually, I'm not going to cover that quite yet. I'll get into that in a second. But POCs will act as support and resistance, like I've already shown you. They also, actually, sorry, I'm going to backtrack just a little bit. So this POC here, if I was charting this, this is January 20th. You can see down here at the bottom of my chart. I actually label my POCs. So I would write here, January 20th, Virgin point of control. The emphasis for the V, for the Virgin part, is that a point of control that hasn't been touched again is going to be stronger than a point of control that's already been touched. So when I'm trading, I know this is hard to see over here because there's a lot going on, but if I move, like to the current trading day, you would be able to see it if I didn't have another POC right there overlapping it, sorry. But you can see over here on my chart, like these labels are very clear and easy to see. So normally when I'm trading, I can read these very well, off on the right side of my chart. But so I label it because when I'm trading, I'm not looking back to say, oh, okay, that Virgin point of control was on February 20 or January 20th. But it is important for me to know that it is a Virgin point of control, because Virgin point of controls are going to act as much stronger support and or resistance when the price comes to it. Whereas a POC that's already been touched by price doesn't have the same strength as far as support and resistance when price comes back to that area. So you might be thinking, well, okay, this POC has been touched a bunch of times by the stock price, and you would be correct. The way that we explain that is we have from the time that the POC is formed, so from pre-market through until market open the next day, this POC can be touched as many times as the stock wants to touch it, and it will still remain a Virgin POC until the next day. If the stock price happens to keep trading on the POC during the next day, it'll still be a Virgin POC until the stock price leaves it and then comes back to it. And by leaving it, I mean like it actually, like this candle obviously left and came back. But I'm saying like actually leave as in the wick or nothing is not touching it anymore. Hopefully that makes sense. I always have a little bit of trouble explaining that aspect of Virgin POCs. But so Virgin POC, at least for while it's being created, it can be touched as many times as the stock wants. After hours and pre-market, it can still be touched. And again, if the stock price doesn't leave it until later the following day, it's still a Virgin point of control until it comes and touches it again. And so, like in this case, this got touched here. When that happened, I would just double click this and then I would change it to a POC, just like that. So now on my chart, I know this is January 20th POC. This might seem a little overwhelming. I chart about 20 charts a day after the market closes. Once you have your POCs on all of your charts, it's as simple as just changing a few of them from Virgin POCs to POCs and adding the new one at the end of the day. So like right now on SPY, I already know I have to come over here and put a POC for today's trading day because I didn't do it yet today. I actually purposely left it so I could show you guys. And then I would normally label it, with the date and put Virgin point of control. So hopefully right now everybody has a good understanding of what a POC is, a Virgin POC and a POC. And so where Virgin POCs get really interesting, at least in my opinion, is this isn't a good example, but if we pretend like this is a Virgin POC, this is a Virgin POC, and this is a Virgin POC, and the stock is trading here, and all of these ones below are just regular POCs, there's a good chance stock will get pulled up to the Virgin POCs versus coming down to the regular POCs. So the more Virgin POCs you have in one direction, there's a good chance that the stock price will get pulled in that direction. And then also here on SPY, you can see I have this labeled 6x POCs. So we can see here, there's one here, one here, one here, one here, one here, one here. To me, this is a no trade area. Because if you look, the price is just going to consolidate in here. And so this is also a very easy trade. When the price leaves that area, I'll take puts to the downside. If it leaves to the upside, I'll take calls. But yeah, anywhere where I have a large number of POCs, I just put a rectangle and I label them so I know not to trade in there. My other favorite thing about POCs is they are they're objective. They're not subjective. So one thing with support and resistance is people will draw like rectangles on their charts, and there's nothing wrong with it. But you don't have like a hard physical line, that's completely objective. It's subjective, and people choose where they think they see support and resistance. And a lot of times they'll be correct, but they don't have anything definitive saying, yes, 100%, this is going to be support and resistance. Whereas with POCs, you do have that. You do have something hard and physical showing you that, this is going to be a support and resistance. So like if we look at a day like February 10th, this was a trending day where we just ripped down. And you can see even with us ripping down, if I actually switch to like, I don't know, 3-minute candles, you'll see that this gets respected. And so let's just switch to a lower time frame. I don't know, 10-minute, 3 minutes, doesn't matter. So you can see it here. Even though we're trending down hard, this comes down close to it. And so POCs do actually also have like a range where, just like a support and resistance, it's not going to be just the definitive line, but it does have a range. So even here, I would consider this coming down to this POC. But then later we actually see it come down, this wick come down and tap it and then take off again. So you can see that even on a trending day like this, the POCs or support in this instance are being respected. Okay. That's really it for POCs. And so this is where I normally would go on to like the next part of my class. But right now we can do questions. If anybody has questions, I guess you can unmute yourself and type. I believe
I've actually got everybody muted, so it's going to be difficult for them.
Never mind, you can't unmute yourself and talk, but
feel free to continue the class.
Well, I was going to say, if anybody has questions, you can type in call options. I don't know if there's another area, but I'm reading call options, so I can answer questions there.
The voice chat text typically hosts a few questions. Kenan is also currently working on finding a way to host additional members because at the moment some people are finding difficulty being able to see the stream. You're currently recording correctly?
I am recording, and like I said, okay. I can share this recording with Kenan, and if he wants to post it as a private video or whatever, I'm good with it. He can have the full rights to this video. So
this is right here in the chat. He should be able to speak.
Yeah, okay. I'm here. I'm trying to.
What's up, Kenan?
How's it going, man? Good to see you. It's funny. You had me laughing on Twitter earlier today, by the way.
I was just playing. I was playing with you, brother. I was actually so shocked when I saw that pop up in your Twitter, and I was like, oh, I gotta mess with him a little bit.
Yeah, you got me there. I didn't know you had a Twitter. I would have definitely tagged you.
No, it's all good. I didn't know. Bro. It's all good. Like I said, I was playing with you.
No, that's all. I know it's all love, man. I wanted to say I appreciate it. The family appreciates what you're doing here, adding some value. And so this video is recorded. It's looking like Discord has a hard cap on how many people can be in here, and they actually increased it for COVID, but they didn't increase it obviously much.
It's like 99 people, I believe. Yeah, it's rough. Yeah.
Which stinks because there's so many Discords with way more members than that.
Yeah, I wasn't even sure we were gonna get all that family this late ready to go for another class. So. I'm surprised we filled it so quickly.
Like I said, this is completely up to you, Kenan. This is recorded. and you can have the video, you can share it, you can post it privately. I don't care, whatever you want to do. For me, this is about just trying to help people out so they can, better themselves as traders, or hopefully I can add some value to people. And I can share it to you through like Google Drive or whatever, and then you can edit it, because I'm not a YouTuber. I don't know how to edit videos or any of that stuff. So I would just be giving it to you
Believe
raw.
it or not,
Yeah.
believe it or not, people tend to like it that way. When
Yeah.
you got so much edits and the video gets distracting, and that people like to see the real, just raw content sometimes. Well, depending on what it is, because they want to hear like your stream of consciousness while you're talking about this.
Sounds good. Well, like I said, I mean, it's completely up to you. If you want to get it out to more people, they can have it. Like, yeah, you can have it and share it or do whatever you want to do. So,
Okay, so first question is,
yes.
what platform is this? Because I jumped in late.
Oh, so sorry. This is on TradingView, and for this particular indicator, you have to subscribe to TradingView, and it's like
Yeah.
you have to do the minimum subscription. It's like $15 a month. That's a bummer in my opinion. And from here, once you subscribe, you search for VPS. Sorry, volume profile session volume, VPSV. So you should be able to see that on my screen.
Mm-hmm.
And these you chart on the 30-minute time frame. And then one of the questions, actually, I'm glad that this just came up in my head. When I switch from the 30-minute time frame, you'll see that these move. So like my yellow lines don't line up perfectly now with this red line, and that's okay. They will respect where they were charted on the 30-minute time frame. But I always get that question like, oh, like when I change time frames, the volume profile moves. Yeah, they will. But that's why you chart them on the 30-minute, and they'll be respected when you're trading. So
When you use this strategy, you have a specific price, or not a specific price target, but a specific profit target, or you just ride the wave up.
well, that I get into that at the end of the video. But I use
Oh wait, so you're not done. You're not
no,
done.
no, no.
Okay, yeah.
This
So let me just
Hey,
shut up and let you do
question,
your thing.
Keenan and
Yeah.
Rockets.
Yeah.
Would it be acceptable? Are you capable of dual streaming to the Discord fam and direct to your own personal YouTube channel?
I can stream to my YouTube. Yeah.
Can you do both or no?
Yes.
Okay, because I mean, if it's acceptable to the boss, we can possibly throw up a links for the folks that can't follow us in the Discord into his personal YouTube to follow this
I think
class.
I think the easiest way to do it would be, first of all, if we just shut up and let him do his thing. Like, so the video doesn't have this spot in the middle of it, and then just have him upload it to his YouTube channel. We just link it.
All right. I mean, whatever's clever for you guys.
All right then, do your thing, man.
Really quick though, Keenan. I don't know if you use Thinkorswim for trading, but I'll minimize that. You can get volume profile on here for free. You can get the points of control on. So it's these yellow lines you can see. That's
Right.
my point of control. And my volume. Well, sorry, actually, these are really small. Let me go to a bigger, and let me get rid of all that. Oh wait, I can't do it that way. Let me start over. So if I go to, you'll see here. There we go. So this yellow line is my point of control on Thinkorswim. And then my volume profile here, and this blue shaded area is the value area. I haven't got into the value area part, but the value area is really exciting for me. There's a trade called the 80% rule, and it's called the 80% rule because it works 80% of the time, and it's really, really easy to pull off. So I love sharing that with people. So like if I go to the 5-day 3-minute, so like here, we see the 80% rule here. what the 80% rule is once this area, this blue highlighted area here has been established during the trading day, and it's established from the stock moving sideways here. So once this area is established and we leave this area and come back into it, 80% chance we go from this side of the blue area to this side. Every time. And the same on the inverse. If we go, if we come down below and back into, you would take calls from this side to this side. And it'll work out for you 80% of the time. So it's an amazing trade. Love to use it. All right, so that's part of the class that I was going to do, but I'll cover that again in a minute. The volume profile and value area. I've got a question here on POCs. You've said POCs are usually good for 30 days. Within that 30-day time frame, does it get less effective with more touches? Awesome question, Sean, and I'm really glad you brought that up because I forgot to cover it. So POCs, they're good for about 30 days. They'll be respected for about 30 days. And after that, I'll normally just take them off my chart. The only exception to that is like, see here, for instance, where this stock has literally come down and touched this and then took off. If this was a 30-day-old POC and I see the stock price doing that off of it like over and over again, that POC is staying on my chart until the stock doesn't respect it. Virgin point of controls, those will stay on my chart indefinitely because those will end up being respected the next time the stock does get down to there, even if it's months later in the future. Okay. So really, really good question, Sean. Thank you for asking that because I'm glad I'm glad you asked because I forgot to cover it. So the next thing I was going to go over is the volume profile. Actually, let me. Somebody want to throw up a ticker symbol, and when I say that, I want like a large cap or a medium cap stock, like nothing penny stocks or anything like that.
Let's do Apple. Everyone knows it.
All right, we'll do Apple. And really quick, I got to let my dog out. I'll be back in 2 seconds. Oh, never mind. My wife got it. So when we're looking at the volume profile, and right now you might be saying, what is a volume profile? Because I haven't explained it yet. The volume profile, actually, let me take off the, I should have showed you guys this trick as well. I can predict like what's happened on a trading day just by looking at this and not by looking at the candlesticks. If you guys want, I can do that really quick. Harry, Webull unfortunately does not have POCs. What I always tell people to do that use Webull, like I love Webull as a platform for people that trade on mobile. I always say just get TradingView and pay that $15 a month. It'll pay for itself. I promise you, these are so effective. Find your POCs on TradingView and then just plot your lines into Webull. So hopefully that helps you out. So let me just clean up some stuff on this chart so you guys can see better. You don't need to see my bull flags or bear flags. So right here you can see this is called the volume profile. This volume here on the side of my chart, it looks like my volume candlesticks down here. And while I'm thinking about it, people ask like, does the time frame affect the volume profile? It does not. So volume profile uses what's called average true range, which is not affected by time. So even if I change to a lower time frame, which I'm not going to do because I'll lose this volume profile, it would stay exactly the same. Okay, so average true range, it's not affected by time. Volume is very important to learn. And while I'm thinking about it, I'll just say I really highly recommend everybody read the book Volume Price Analysis by Anna Cooling. It should be one of the first books you ever read as a trader, in my opinion, because without understanding volume, you can't trade effectively. Volume profile, it tells us a lot. And what it is this is all of the buying and selling volume that's taken place, on any specific price point on the chart. And so where we end up with areas like this here, actually, let me just change the color of this so it stands out a little better, maybe. And I'm really sorry, guys. Like I said, I'm not a professional speaker or anything, so this will be a little rough. I apologize. But so you can see this area here where I have what's considered a volume shelf. If I turn my candlesticks back on, I guarantee you we traded sideways in this area for a bit, for probably quite a bit. Where you have an area like this is called a naked belly. Okay. And so how volume shelves work, at least the way I like to explain it, is anywhere that you have a shelf, you can set like a book on top of that shelf and it'll stay there. Or you could set a cup on top of that shelf, it'll stay there. I also like to refer to them as steps or like rungs on a ladder. And so anywhere where I have a step, I can take a step up or down from that step. And as long as I have another step to stand on, I'll be able to stay there. So the same thing with stock price. If I have a volume shelf or a step and I step from down here up to here, I can chill in this price area for a while because I've got this volume support, this stair that I can stand on. And if there happened to be another volume shelf up here, I could jump up there and I could hang out there for a little bit. And then I can jump back down to this one and hang out for a little bit. And so with this here, again, I don't know how this trading day went. I turned off my candlesticks, but I can guarantee you at some point in time during the trading day, I went from either up here down to here or from down here up to here. And the area where I'm going to end up hanging out the most on the chart is going to be roughly right around there. And I'll turn the candlesticks back on and you can take a look. But so price, where you have a shelf and then you have a narrow belly and then another shelf, will move very quickly from here to here. So if you establish where these shelves are and draw a line, the minute your price crosses above that line, you would take calls. The minute it crosses below that line, you would take puts. You're going to have a rock solid trade. And so right now, I'll turn on the candlesticks. We'll take a look at this, and you'll see at some point we either traveled from here up or from here down, and probably very quickly. Okay, so here comes our candlesticks, and there you have it. So we consolidated sideways in here. If you drew these lines, if you know trading, these wicks would have happened quickly, so you wouldn't have grabbed trades there. But where this would be the key for me. So we test the line, we pull back above it, and then we retest the line. I would take a trade right there. These ones you might get faked out, but more likely than not, you're not. And even if you did take a trade here, as long as you're shooting for 10 or 20%, you would have been able to get in and out and get your 10 or 20%. But right here, if you take puts, boom, you're solid. You come all the way down to this next volume shelf. And you guys might think, okay, when I first opened Apple, I had the candlesticks turned on. I promise you I did not memorize this chart while I was talking to you and had the candlesticks turned on. If you want, I can turn off the candlesticks. Like if anybody doesn't believe me, we can look at another area that I haven't seen. Like I can tell you here, this day, we traded sideways all day long. And again, this is not pre-planned. I asked for somebody to give me a chart, and I believe Kenan did. And there you have it. We traded sideways all day long. Like there's nothing to trade here on Apple on this day. Unless you're, some traders, some scalpers will play bounces, from one side of the value area to the other. I don't trade like that. It's very risky. It's a good way to lose money fast. But so you can see, just by reading this volume profile on the side, without even having candlesticks, you can kind of see where price is going. And take it a step further, if you look at volume, a lot of people don't chart volume, and you should. Volume's descending here. And again, you're going to say, oh, I already saw it went down. Well, okay, cool. And then I have volume ramping up here. But this is selling volume, mostly it looks like. So where I have volume going down, I'm probably going to see um, the stock price fall. I love to look for volume anomalies. That's one of the things that you'll learn if you read Anna Cooling's book. I can try to cover it really quickly if I see something. But so you can see it here. I mean, it lines up perfect. Like, if you use confluence points when you trade, and you notice that you have a volume shelf here, and you draw your lines, and you notice that volume's trending down, and you tap that line here, and then you come back and retest it, and you come back through here, like this is just like a perfect, beautiful entry as a trader right there. And that's what you wait for all day long. So a lot of people like to jump in trades like multiple times a day. As an example, yesterday I took one trade and it was on SPY, and I can show you what it was. And that one trade alone grew my entire portfolio by 5%. And that's what I look for every day. I try to grow my portfolio 5% a day. I've said this before in chat a lot, and I'll say it again here for anybody that hasn't heard it. Even if you start with a 1K account, you grow it 5% a day. At the beginning, 5% doesn't seem like very much. That's $50. But in a year, if you continuously grow by at least 5% a day on $1,000, in 1 year, you will be a millionaire. And that's how compound interest works. And it's amazing. And so you should never look at the financial gain as a dollar value. You should look at the percentage that you're making every day, and you should shoot for that, whatever your goal is. My personal goal is 2 to 5% every day on my portfolio, and I pretty much hit it every day. Like I think the last time I had a red day was over about 2.5 weeks ago. So I haven't had a red day in 2.5 weeks, if that helps anybody out with who you're learning from today. And that's not ego based. I work hard. This is not an easy game. I work 12 to 16 hours a day, studying charts, reading books, learning, also educating other people. I like to give back as much as I can, because this was hard for me to figure out. And, if I can just help one person, like on the right path in the right direction, my time was worth it. So that's the person you're dealing with today. Anyway, let's get on to more exciting and interesting things. So with volume profile, again, I'm going to turn off the candlesticks here. If you have something that looks like a P shape, like this day here, it's skinny here, and then we have a P here. This is going to be a day where you're seeing upside. Where you have a day, I just got to find one to show you guys. A lot of this is consolidating sideways. Like this day it's a rough P, but it's a P. You would see upside here. And so a day like this, this day, I guarantee you we rip down. So this is a lowercase b, and price probably started up here somewhere and came down. And I'll turn the candlesticks on and we can look at that. Oh, I'm wrong. Oh, no, I'm not. We opened here. We didn't open up here. So this is showing, this volume here is after hours. We opened up here and we came down to the downside here. So there's our B, okay? For a second, I thought I was wrong, and I was actually surprised because that doesn't happen very often with volume. And again, not cocky. Just volume profile is pretty easy to read once you know how to read it. I don't know why I'm going backwards here. The one thing I don't particularly like about the value area volume profile on TradingView is the value area is not very clearly indicated. So the value area on TradingView is this highlighted area here, and the shaded area at the bottom is just the volume profile. So to see the value area on TradingView, you have to like draw a line or just watch it with your eyes, like make sure it's on your chart so you can see it. So to do that 80% rule, it's going to be this highlighted area on on TradingView. And if we turn our candlesticks back on this day, it didn't really happen. We came back into the value area, touched the top. And again, like I was saying, there are traders that will take a trade here to the downside, and you would have been correct. That 80% rule played out. But for me as a trader, I like to see it just come out at least a little bit and then go back inside to take that trade for the 80% rule. Hopefully that makes sense to everybody. Why? Oh, I keep drawing on my chart and trying to erase the old drawing, and I'm erasing the new drawing. I'm just going to peek at the chat really quick to make sure I don't have any questions regarding volume profile or POCs. Oh, so I just saw that somebody said they're in the voice chat, but they can't see my screen. There's a limit on the number of people that can see my screen. I don't know if somebody can share their screen of my screen so other people can watch. That would be awesome.
Maybe I can try. This is Asuri.
Asuri, if you do it on like the lowest FPS, like the 15 FPS.
The thing is, when you stream Discord using Discord, it doesn't infinite loop usually.
I actually do it pretty often, and I don't.
At least mine does.
Oh, that's weird. Where are you from, Asuri? I love your accent.
I'm from London.
Oh, I love it.
So it's pretty late.
I'm British too.
Oh, you don't sound it.
I've lived all over the world, so I adapt to accents very quickly. Just like je parle français en accent français. So like I lived in France for 4 years. I have a French accent when I speak French, like, yeah. But so, yeah, my family's like actually mostly from the London area. My grandparents lived in Kent. I went to school in Devon for 4 years.
Well, if you know Kent, I'm actually moving to near Sevenoaks. So.
Oh, nice.
I mean,
nice. Yeah.
Yeah.
I love Kent. It's so beautiful there.
Yeah.
So anyway, hopefully we get a couple. It looks like JSG's sharing his screen, so hopefully some people can hop in there and see the screen as well. Yeah, trying to trying to get everybody covered here. All right, so we'll move on. I didn't see any questions. Yeah, I didn't see any other questions.
Do you mind if I ask you a few questions?
Of course, yeah, absolutely. Go ahead.
So I mean, I trade completely different. I use like RSIs, Bollinger Bands, MACDs. How is there any way to combine the two to get kind of so you compare the two together? How would that work, or do you not really do both systems?
Yeah, so I don't. But I mean, you can combine RSI with what I'm teaching, and that flows really well together. So I haven't got to how I actually trade yet, and I will at the end. I really just trade on technical analysis.
That's the only way to trade if you actually want to make money.
Yeah. So when I'm trading, like, this is my chart. I'll show you guys really quick. I got to remove all these red lines I drew. So when I trade, like, this is what I'm looking at generally. And I would probably have a line here. I haven't traded Apple in a while, but I would put a line here. Actually, no, because this January 28th VPOC is covering it for me. So if I was trading Apple, let's just say, for example, I'm getting ahead of myself, but that's okay. We will cover this a little bit more. I like to talk about technical analysis a little bit. So, because I mean, I could talk about technical analysis all day, but I can't teach like a class on technical analysis. It would be way too long. So this part here, I'm not trying to take a trade unless I have some like previous information. Like if I noticed there was like a really strong support area on the previous day, and I had a line drawn saying, hey, if I go below this line, I'm going to take puts. Otherwise, the beginning morning here, I'm not trying to trade. And this is what I talk about. You really have to be patient. And I will show you guys in a little bit the one trade I did take on SPY yesterday. And I'll show you the one trade I took on SPY today as well.
I have a question for you that I think a lot of people can benefit from.
Yeah, absolutely.
And that is, what is your mindset? And I want everyone to really listen closely on this. What is your mindset on taking between 2, 3, and 5% wins daily rather than going for 100% every single day?
Well, so we're probably, it sounds like we're apart on this because you're saying 1, 2, 3, 4%. I never will take 1 to 4% profits. And I'll explain why. So as a trader, you need to establish rules for yourself, and your rules should be clear and defined. And this, like Kenan said, you really, really, really want to listen to this, because in my opinion, this is the second most important thing in trading. The first most important thing is going to be your mindset. The second most important thing in trading is you you have to have clear defined rules. And whether that be taking negative 5% as a stop loss and positive 10% as your win, you always want to shoot for like a 2-to-1 risk reward. So if you're stopping out of trades at negative 5, you want to take positive 10. If you're stopping out at negative 10, you want to take positive 20. If you're stopping out at negative 15, positive 30. If you're stopping out at negative 20, you want to go for positive 40. You want to do this consistently on every single trade. The reason for that is, even if you're a bad trader and you're basically flipping a coin and entering a trade, you will probably be correct 50% of the time. And if you're doing 2-to-1 risk reward 50% of the time, you are a profitable trader. At a 2-to-1 risk reward, you only have to be correct 34% of the time. So for every 100 trades that you take, you only have to be right 34 out of 100 times, which is very easy to do. So then if I talk about myself as a trader, I'm correct roughly 70 to 90% of the time. And so as long as I'm taking that 2-to-1 risk reward, I'm very profitable. And not only do you want to take that 2-to-1 risk reward, you want to set a goal for yourself. So like I was saying, I have a goal where I really strive to hit 5% gains every single day. Once I hit 5%, I literally turn off my trading software, and I might stay on my computer. So like I can't trade on TradingView, but I can look at charts. And when I'm looking at charts, I'll try to help other people with trades. But as far as me as a trader, I hit my 5%, boom, I close out of TradingView and I'm done for the day. I'll never open it back up.
You brought that up. Mm-hmm. What experiences led you to cut it off there?
FOMO. It's so easy, especially for me. Like, I'm up 5%. I actually did this today, so I'm full of crap. And this is actually, you know what? As a trader, you also have to be willing to talk about your losses, and you have to be willing to talk about, where you've made mistakes, because you need to reflect on it yourself as a person so you don't make those mistakes again. And so today is actually a perfect example for me as a trader. I did something stupid that I shouldn't have done. And I gave back, I want to say 2.5% of my gains on the day. I ended the day, or no, 2%, no, 3%. I ended the day today 2.5% in the green, where I originally was finished trading. I was 5.5% or 5.4%. I don't remember the exact number, but right around that range there, up on the day. And I told myself, okay, I'm done trading. And then I took a lotto for the FOMC meeting notes. I really was expecting SPY to tank. And so I took some SPY puts and I got wrecked. I was trading within my limits, so it doesn't hurt my account. It doesn't hurt me as a person or as a trader, but I was stupid because I gave back 3% of my gains on the day, and there was no reason for me to do it. I should have turned off my computer and walked away and been done. So I learned less is better as a trader. And actually, while we're covering this, let's just look at SPY, and I'll show you how less is better if I can type. Here's my trade on SPY today. So, I shared this in the call Discord. I didn't know. I mean, so this is an ascending wedge. Normally, these happen. Well, actually, I'm sorry, I take that back. These always happen in a downtrend, and normally you're gonna play puts from here. And so, I was I was waiting for a long time for this to break. I was watching it just build, and it finally broke. And this one trade from the break of this trend line down was enough to grow my account 5.5%. So that's all you need is one good trade every day. Like if you find a pattern and look for it and wait for it and play it, like to me, this is a high quality trade. My only fear is right here. I have a POC, I believe. Oh no, this is today's POC. So actually I wasn't even worried about that. My only fear was this previous low of day. So I always plot like the previous low and the previous high of the day before, because a lot of times those will act as resistance. But the setup was beautiful. Like this is a beautiful rising wedge, easy. Like you'll hear a lot of traders say like, look for the retest. I had several, like boom, boom. It kept retesting. And then on this wick here, and actually there's a lot of great information on this chart, so we'll get into it a little bit more. We're getting into more of the technical analysis stuff that I wasn't ready for yet, but that's okay.
Before you do that, I have a question.
Mm-hmm.
You obviously are aiming for 5% a day.
Yes.
How much of your capital are you exposing? I know obviously are you using stop losses, or are you buying puts or calls that are only worth a certain value of your account, a certain percentage? So if you lose, say you don't seem like the person to hold an option to zero. I mean, you shouldn't do that anyway. Mm-mm. So you're never using all of your capital.
Never.
I think that's a key thing for any new trader or any trader. Don't you overexpose yourself. Even if you have stop losses, sometimes you can't get out. There's spikes in the market. You need to make sure that your option is not too big, otherwise you could end up getting hurt. Yeah. So obviously, I mean, how much would you say you use to get your 5% of your main portfolio? Because it wouldn't change no matter the size of the portfolio.
Yeah. So that's a really, really good question, and I'm going to answer it, but like really in depth. So let me just finish.
Sorry.
No, you're good. That's a great question, and I want to cover it, but I want to cover it like really in depth. So I want to just finish this really quick because I'm almost done. This wick here on this candle is so much selling pressure that like the minute it touches this trend line, this is a clear, easy entry. I'm not worried about a rejection here. To me, this is just a great entry on a trade. And then if we look, the other confluence point that I have is, and again, got to read Volume Price Analysis by Anna Cooling. If you look at volume, it's just been trending up. Negative, like selling volume, trend, it's slowly building with each candle. It's getting bigger and bigger. That's like a clear indication to grab those puts. On the inverse, if you have, if you have volume building to the upside and it's positive, so my blue candles are downside, white candles are upside. So where you see this volume building like this is an easy call entry as long as your technical analysis is saying to take calls. So you look for that momentum growth, boom, boom, my volume's getting bigger. and I hit this trend line, I'm in this trade like this is a full send. And as you can see, I mean, it's a great trade. I think I exited the trade. Actually, I know I exited the trade right here where I started seeing this wick pull back. I exited the trade and I made my 5.5%. And I don't look at my P&L while I'm actively in a trade. I don't really look at my, like, I entered at this price and I'm now here. I'm looking at the candlesticks and I'm watching the volume. I'm also watching ES, NQ, AD, and VIX. And I'll cover these a little bit more in depth, but towards the end of the video. But this is ES, which is a future for the S&P 500. This is the NQ, which is the E-mini for the NASDAQ. AD is, actually, I'll just cover it right now. AD is advancing and declining index. And so you can see this is represented by a number. And I'm just going to read this. The advancing declining index is a market breadth indicator that represents the cumulative difference between the number of advancing and declining stocks within a given index. And so for this one, anytime you're above, and actually this is perfect for today. If you're at 500 on AD, that's neutral, neither bullish or bearish. If you're over 750, that's bearish. It's bullish. If you're below 0, anything negative is going to be bullish. And so you see, like, we pull down, and then when we start ripping up, this is all bullish momentum. And so AD runs in parallel with the market, SPY, our futures. And VIX is basically, it's the same as VIX. It runs inverse. So if I'm entering a trade on SPY, like if I'm taking puts, for example, like I did today here, actually, I'm not, yeah, it was here on this candle here. And on AD, it was here. And VIX, it would have been here. And on NQ, it was here. So I'm watching ES, NQ, and AD to make sure they're all going negative when I'm entering into a put. And I'm watching VIX to make sure that it's going green when I'm going into a put. And then the inverse for calls. I want VIX going red, NQ, ES, and AD going green. So to your question, as far as sizing, you're correct on one aspect, but also wrong at the same time. So the way that I trade is I use 1 to 2% of my capital per trade. And that can look several ways. So like if you're trading with $1,000 account, you can risk up to 2% of your account. And if you're good at math, 2% is $20. And you're probably thinking, that's nothing. Like, how am I supposed to trade with $20? And the answer is you're not. If you're using like a 20% stop loss, that means you can enter a $50 trade and risk $20 of that trade. And that's your 20. I'm sorry. You can enter a $100 trade, risk 20%, $20, and that's your trade. So if you go negative $20, you get out of the trade and you only risk 2% of your capital. The inverse, if you enter that $100 trade and you're going for 2 to 1. So, and again, I use negative 20 and negative 40. So if that's not you, whatever your risk reward is, negative 10, positive 20, great. I go for 40%. So if I was using that same $20 risk, I would be shooting for $40 of profit on that $100 trade. Now, the one part, and again, I'm not like trying to put you down a story or anything like that, but the one part where you were wrong is I will enter a lotto play with that same $1,000, portfolio, with $20 of capital. So like, let's say I want to take a $20 lotto where the contract price is $20. I can risk it all the way down to 0 and I'm still only risking 2% of my portfolio.
Yeah, so I kind of figured that was the case, more so that my trading, even though I use leverage, it's basically the same.
Mm-hmm.
If I have 1,000, I'll use 100 for my lot size, and then my margin will bump that all the way up to like $20,000 or something stupid.
Yeah.
It was 20 times. No, it's $2,000 for the Nasdaq, and then I'll only lose what I'm willing to lose on it. It's exactly the same way of doing it.
Mm-hmm.
I kind of just meant you wouldn't have a 10% capital size call or put and let that go to zero because you're using
No,
the
never.
appropriate stop loss or picking the appropriate option like value,
Yes.
the contract cost. So you're kind of like doing either or, and it always has to be within your limits.
Absolutely.
It's just so important.
Great point.
So important.
I was showing when I show my chart like of the allocations towards your foundation or any individual stocks or swing trades or options or anything like that. I've noticed that so many people have, they traded 50% of their portfolio. We've heard the horror stories of people blowing up their accounts to zero. And then I had to really say, look, at no point should your options, especially if you have a sizable account, be more than 5% on it, like just on options in general. Like you should keep it rather low. So then, especially if you're just learning the game, it's just important because you don't bet the farm on any particular one trade. So then you lose everything. You could win 99 times in a row and then bet everything on the 100th one and then lose it all. So it's really, you got to really practice risk management.
Yeah, it's very important. You also have to have no feelings. Like my wife will always tell me, like, I can never tell if you made money or lost money because your affect is always the same. Like I don't, when I made 5% on the day, I don't jump up out of my chair and start doing a dance in my room. I'm completely like disassociated from it. It's a business. And so you have to treat this like a business. And this is a really important concept. Like I don't, like if you were a business owner, you're not going to walk into your business and like risk losing your business on like one, like buying one item. Like you're just going to buy one thing, like literally like one item to sell in your store and hope that somebody walks in and buys it. You would never take a risk like that. As a business owner, you're running a business, you have to be smart. You have to get, inventory to bring customers in, to have them have products that they can buy. And you have to be making, 50% on every sale. Same thing. You have to be making, you got to be making your profits on every trade. And as a business owner, of course, you have costs. Those are your losses. Those losses are also your education costs. And you shouldn't let them affect you. They shouldn't get you down. Because as long as you're using proper risk management, and you're using proper account sizing, and you're using a 2-to-1 risk reward, I guarantee you will be profitable. Like you can't not be profitable. Like the worst trader in the world will be correct 50% of the time. You enter 100 trades, like I guarantee you're going to be right roughly 50%, maybe 49, 51, but it's going to be close. And as long as you're using that 2-to-1 risk reward, you will be profitable.
Especially if you listen to your strategy and don't abandon it halfway through.
Never. Like, yeah.
I mean, I'm guilty of this in the past. I mean, I've been doing this over 10 years now. When I was a student in my teens, I'd have my strategy. It was working really well. And I'd lose a few trades. I'd get frustrated. And then I'd throw my trading strategy out of the window. This is what I used to do. I don't do this now because, and then I'd start trading with emotions. And I'd lose. And then I'd be going with more money to try and get the money back. Because the way it works when you lose money is you need to win more to get that money back, and it's a very slippery slope.
Yes.
If you are not using the correct risk management and you lose at the start of your trading journey, so you're a new investor, it's really hard to get back. If you're experienced, sure, you could bounce back, but if you're new, it's even harder if you lose right at the start. You can't be gambling like that.
Yeah.
So
it's very difficult. There was something else that popped in my head while you were speaking, Asuri, based on what you said, and it was a really, really good point, and now it's gone.
Which bit was it? Maybe I can help.
don't remember.
So I was younger. I was using more to try and get so riskier like lot sizes for me. So I was trading with more capital to get capital back. But basically, I was getting stopped out by news because even though I had a stop loss, I was using too much in my. I learned this the hard way. I thought, oh, I've got a stop loss, I'll be fine, even though I'm using 90% of my capital. It didn't work.
Okay, it's back.
This was like 2008. It did not work. So
I've got it now.
There you go.
My point was never. So when I say this is for option traders. This is not for stock traders. Never, ever, ever average down on your contracts. Never. It is the worst thing you can possibly do. So, you know, a lot of traders talk about averaging down, and that's fine if you're buying stocks, because with stocks, you know, you're not losing value based on time. You can hold that stock indefinitely. Eventually, the market will be favorable. It'll go your direction, and you can get out of the trade profitable. But with options, you have theta decay, which I'm sure you all know, which eats away at your contract, and you can't stay in that trade forever without the contract going to zero, which it will. And so a lot of newer option traders make that mistake of averaging down into trades. And some people might be thinking right now, well, I've averaged down before and I ended up making profit. You're gambling and you got lucky. And there is a way to kind of average down without averaging down, and I'll explain how that works. But so when you average down, you're just throwing more money at a good trade. If you look at Kenan's Twitter, where he shared that, I don't even know what to call it, that spreadsheet or whatever with the percentage loss gain, where if you lose 50% on your contract, you now have to have that contract go up 100% for you to just break even. And that is difficult to do. So if you think about all the times you, as a trader, where you've had 100% trade, they're less often than your plus 10 or plus 20. So that's why it's so important to cut at a predefined number, negative 10%, negative 20%, whatever that looks like, and not let it go to negative 40, negative 50. Like at that point, it's almost impossible for you to recoup your money. And then you get into FOMO and you throw more good money that you have like banked into that trade that's already failing. Like you might as well just set that money on fire. And again, you might have done it and got lucky and that's great. I'm happy you got lucky, but stop doing it, because you're not going to always get lucky and you're going to end up just burning your money. So the way that you can average down per se with options is, let's say I take a trade here on SPY. Let me just put an arrow so everybody knows where I'm talking about. I grab puts here on SPY and it rips up and I'm like, oh, damn. You know, now, okay, let's just pretend I haven't hit my negative 20% stop loss, because I guarantee you, me as a trader, I am out of this trade. If I hit negative 20, boom, I'm done. I'm not sweating it. I'm going to look for my next good entry. And so I reach here and I'm still not at my negative 20%, but I still really think that I have conviction in this trade where I took it. I really think the puts are going to play out, and I want to put more money into this trade. What you can do is, let's say here I bought whatever, $50 puts, and it comes up here. Instead of adding more money to $50 puts up here, I can add money to a $51 put up here. And this trade is more likely to go profitable than this trade. So I'm technically averaging down, but I'm not throwing more good money at this negative trade that I'm in, this $50 put. I'm going to take a higher strike price, like a $51 or $52 put, and put money into that trade, because I still have conviction that these puts are going to play out. But I'm not going to throw money at an already failing trade. I'm going to throw money into a new trade that I still have conviction that this trade's going to play out. So hopefully that makes a lot of sense to everybody. That's how you average down as an option trader. You don't throw more money into the same contract.
Yeah, averaging down is if you do it, it's a dance. It's really I have to think of it like a dance, and it has to be pre-planned, like choreographed, in terms of if your pattern broke, then you shouldn't average down ever. You should get out of it because
Yeah.
then you're trading it off of you got into a trade that the pattern and the trend no longer exists. So then averaging down is throwing money at it. This is why, you've seen me do an average down because I feel as if the way I'm looking at the charts, oh yeah, we're still on a downtrend. I just threw my first strike in there to just get some skin in the game, and now I'm gonna establish a real position or something like that. And it becomes sort of a battle. But once you see that your technical trend is broken or your pattern is no longer viable, then you should just take that loss. Take the loss. Like today, when I got into the Lucid, I think I was in a Lucid put, and I wanted to be in it for like 3 minutes. It went up 5%, and then I was like, I could get out here, but let's see. And then it started to go into a loss. We saw the double bottom form. We saw the neckline break, and I was like, I could average down here, but then that would be running, trading with my heart. So then I just cut the loss, right? And I maybe lost what, like 17% or something, but it was like $30 or something like that, and just took the loss. And then you look at Lucid for the rest of the day. If I would have stayed in that, I would have been down like 99%. But you take a small loss, and then every now and again, you're going to get into other different calls that run up way better, but you have to reduce the amount of money that you lose so you get to keep. When you make a gain, you don't want to give it back. You want to basically like lock it in and then add that to your overall portfolio.
Yeah, I mean, so what Kenan just said, everybody trades different. And so, like I said at the beginning, I'm not all knowing, and you have to establish your own trading style. So people might trade differently than me, and there's nothing wrong with that. I do know people that enter a position like consistently where they'll enter because they're entering it at like a more risky time. So like, let's say for instance here, this is, I told you guys I would show you the two trades I took on SPY. This was today, and this was yesterday. So I know traders that they see this come down and tap, and they're expecting a break of the trend line, and they go, okay, I'm grabbing puts here. And then they do that at a very risky spot because they're not waiting for confirmation. So for me, this comes down and touches, and then we come back across. So this is like a retest. For me, this is a clear entry on a trade. Or if you want to be even safer, you can use the last touch of the trend line. So here, hopefully you guys can see that, this wick touched here. You would take puts here when you cross this line if you want to do a safer entry. But so I know, professional traders that will take that risky trade here because they want the higher risk to reward, and that's great. That works for them. But they also enter knowing that they'll also average in, when it goes the other way, because they still know that this trend line is going to get broken. So that's
Right.
that's what Kenan's talking about.
It's like a choreographed dance where you pre-plan.
Yeah. So nothing wrong with that.
I actually did that exact trade today. So on the first one, because it broke so sharply, just in case it was going to really go,
Here?
yeah, pretty much. And I had to average in 3 times, but I'm not using options, so it's much easier for me. But it's the same principle. You have to really know that the chart's going to play the way you want it. And there will come a point, though, I was going to ask you this. Obviously, it feels bad for most people, not yourself, because you're experienced. When you average in a few times and it still doesn't go your way, because anything can happen, you really have to have that conviction to pull the trigger and take the loss. There's just no getting around it.
But you have to have no emotion about it. That's the big part, is you really just have to get to a point where for you this is a business, and you're not getting upset when the trade doesn't go in your favor. And a lot of these, these are measured moves. I'm not really showing that, but this is just some TA for you guys. If you saw here on this ascending wedge, I drew a Fibonacci level from the top to the bottom. And really your first exit is going to be the negative 272 level, which we didn't quite reach, but it was close. Your second exit is going to be the golden fib level at the negative 618. And then the same thing with like a bear flag or a bull flag. I'll just draw it for you guys really quick. I always go over this. This is where you as a beginning, or sorry, I'm not trying to assume that everybody here is a beginning trader, but if you are a beginning trader, this is where you want to make your bread and butter when you first start. You find bull flags and bear flags and just trade them all day long. In this case, this is actually like a bull pennant. I don't bother with the technicalities of the name, but it's a bull flag. I'll draw the flagpole just for people that can't see it. So you just go from the low to the high, and then you draw a line down. You might have to adjust this, like as it's forming, but really I'm going to take the top of this wick, and that's going to form my line. And then once I cross above, so this is going to be the same thing. Like I was saying, your safe entry is going to be the last touch of this trend line. So your safe entry would be this wick right here. Once you cross above that wick, you would take calls. The riskier entry is going to be either when this wick went through this trend line or the retest of this trend line, you would take calls. And these trades are just so easy. Me as a trader, and this is something I really like to get into, is you might think like, how am I supposed to draw all these lines while this is happening? And like, this is too complicated. It's too hard. You don't need a bunch of lines. With a bull flag and a bear flag, you just need one line. So you go from the top of the flagpole, and then you grab this top wick here and extend it out. And you can extend it really far. That way you don't have to keep adjusting it. And then when this trend line gets broken, I mean, you can see where the wick is. You can take it there. Or like I said, you can take the retest of this trend line. And then if you want to get fancy, you grab the bottom of the flagpole, like I was saying, down here, with your Fibonacci levels up to the top of the flagpole. And then this tells you where to exit the trade. And your first exit is going to be right here at the 272 level. So boom, out of the trade there. Or a trim. If you took, if you have a big portfolio and you took 10 contracts, right here you would sell 8 of them. And then you leave all profit, like 8 contracts from here to here. The 2 that you left running, you still have profit, plus you have free running profit, like that you can risk losing because it wasn't your money to begin with. Your second exit is going to be the golden fib level at the 618 level here. And then your third exit, if you still have a runner, would be this 786 level. And then I'll show you guys really quick my fib levels. And again, this is recorded, so you don't have to like try to screenshot this or write it down. But these are the fib levels I use. These are the only ones that you need. And so those are your 3 trim areas: 272, 618. 786. And then you can see in this instance, like I said, a bull flag or a bear flag is going to be a measured move. Your first measurement is the 272. Boom, you're good. You made profit. Next trim is going to be the 618. Boom, you're good. You made profit. You got pulled back down here. Technically, for me as a trader, if I take a trim here, if I take a trim here at this 618 level, and it goes up, and I still have a contract. I mean, honestly, I probably would have got out on this wick here. But if I didn't get out up here, and it came back down to this 618 level, this then becomes my stop loss. But if you're more resilient than me, and you played all the way down past your 272 level, back to the upside, you would have got that third trim at the 786 level. I don't think very many people would hold through this, though. Especially after being that profitable in this trade. So like that should be your bread and butter as a new trader. And what I really recommend, you don't need to draw the flagpole. You don't need to draw the bottom of the flag on a bull flag because you're only playing the break to the upside. So what you really want to do, and this is really like aimed at people that are newer or that are just barely starting to learn technical analysis, you want to just step back and slow down and look for these patterns. I would focus on learning bear flags and bull flags first. And what you'll want to do, sorry, let me pull this up really quick, is go on YouTube or go on Google, and do a search for candlestick pattern cheat sheets. Or I'm sorry, I'm going ahead of myself again. I grabbed the wrong one. Go on Google, do a search for trading pattern cheat sheets. And this is not a very good example, I apologize, but find a good one that has all of your bull flags, bear flags, double tops, double bottoms, head and shoulders, cup and handles. Don't let this overwhelm you. Focus on finding bull flags and bear flags. So your very next day after you get this chart pattern cheat sheet, literally just spend the day watching SPY or whatever tickers you want to watch. I really recommend just focusing on one ticker when you're first learning and just look for bull flags and bear flags all day long. And all you have to do is draw the top of the flag. And like I said, if you want to, you can draw your Fibonacci levels. And then if you're not comfortable yet trading bull flags and bear flags, that's fine. I would recommend drawing your safe entry, the last touch. And then just see if the trade would have worked out. And then look again like for more bull flags and bear flags. And if you're still not feeling confident trading them, that's fine. Just draw them, watch how it plays out, see if it works out in your favor, see if you were correct. You also want to watch, your volume. So like once you start getting like really good as a trader, you see this candle here. It's probably a hammer. When I see this wick and this buying pressure, and I see down here I have all this, actually no, sorry, this happened after the fact. Whoa. But all of this buying volume is here. And
if you want to do some live TA, the Nasdaq's kind of crashing right now. It just had a bear flag, and it's gone down like 120 points in 5 minutes. I'm trading it right now. It's because I'm in the UK, so I can. It's glorious. But this is literally what you're talking about in real time.
Yep.
You couldn't get any better.
So if we do 1 minute. Wow. I mean, it's
so clear because of how long this one is. You could have puts at the top. Yeah. I closed one trade at the big bar where it had that wick. I closed it. This is 2 before it's gone green, and then I reopened again as it bounced off my Bollinger Bands because I have different trading setup. And I just closed another one now.
Actually, let me just do it here so it's easier.
So I'm now completely out. I'm waiting to see what happens because it's too volatile.
Why? What?
Price should be 14,461 if you got the right chart.
That's weird. I'll go back to the chart I had. I don't know why it's not coming up there. But so here, if we look, I can zoom in, and we can do TA here. It's yeah, I mean, this is your entry here, and then we have another bear flag forming right now. Right there. And then we have another bear flag here that's forming as we're speaking. So those are your entries. And you can see here, I took off all of my drawings. That's okay. So like he was saying, as this forms, gosh, I never chart on here. Where's my...
Sorry to get you out of your comfort zone on something really
Fibs.
strange, but I just
No,
figured you were
this
talking
is
about them,
great.
and this is literally as it's playing out. So I think there's going to be either a reversal here because of that doji, or it's going to do another thing.
No, this is great.
50% right there of that small move.
This is great.
And yeah, so you can do a lot with this.
Yeah. So like this is, you know, I'll call it there. Yeah, so I mean this is perfect. Like you have your sorry. Trying to make this more visible. So you have your you know, your first trim here at your it comes up differently in TOS, but this is my 272 level. So it comes up as 127.2. My next trim would be that 16.8 that I was talking about. And so this is, you know, this is a beautiful trade. And this is exactly what you want to do. Like I was saying, you don't have to draw your flagpole. You technically don't have to draw your fib levels, but they do help you with your exits. But so all you have to do is just draw this bottom line. You know, if I was doing it correctly, like in full technical analysis glory, it would look something more like this. But again, you're not looking for a break of the top part of the flag. You're just looking for a break at the bottom of the flag. So I don't even bother drawing the bottom or the top of the flag. I just draw the bottom because I'm just looking for the break here. And then the same thing here. This actually probably is no longer a flag. If this retraces back more than 50% of the flagpole, it would no longer be a flag. And so we measure that by going from the bottom to the top. And I do have the 50% level on here. So if I remove this flag, sorry, you can, and see here we would enter puts right there. And your first trim is going to be the 272 level. He's like, thanks for doing the TA for me. Anytime, got you. But so you can see this gray line here says 50%. If this green wick happened to touch this 50% level, it would no longer be a bull flag. As long as it doesn't retrace back to that 50% level, it's a bear flag. I'm sorry, I think I said bull flag. But yeah, as long as we don't come back and touch the 50%, it's still going to be considered a bear flag. So going back to what I was saying about, like, as a newer trader, if you literally just look, and I'm going to draw this one really quick just so that, you know, you guys can see it a little bit better. If you just look for these flags all day long, and again, if you don't feel comfortable to trade them, that's fine. Learn to find them and draw your charts. And then once you've seen them play out, you should start to feel confident entering those trades. But you really want to take your time. Like, trading should not be something that you're rushing into. You should be like stepping back, taking your time. You know, like me, I'm a profitable trader. And if we look at, you know, my SPY chart from the other day, I think this is a great example. If you look at this, I did not enter a trade until 9:06 in the morning. I live on the West Coast, so I sat here staring at my screen from 6:30 in the morning until 9:06 before I finally entered a trade. I took one trade, made my 5 and whatever percent. I believe it was like 5.5% yesterday I made as well. And I was done. That's it. I'm done for the day. So you really, like, you don't want to rush into trades. You don't want to FOMO. I can't emphasize this enough. There's a million trades happening at any given moment in time. Our job as traders is to find them. But again, we don't need to rush. And like, even just looking at this chart, like, if you miss the first move here, no worries. You have a bear flag right here. So hopefully you guys see how easy this is. Like, you just draw this line. And then when you cross the line, you take puts. If you can draw a line, you can do technical analysis. And so once you get comfortable spotting and finding bull flags and bear flags, then you want to expand your game a little bit further and maybe start looking for like triangles or wedges or whatever, cup and handles, head and shoulders patterns, things like that. I know Kenan did a technical analysis video the other day, and I watched it really quick, like skimmed through some of it. But he has some really good key points in there. And I should have actually covered this at the beginning of the video, so I'm going to hit it really quick. With charts, you have one of three patterns happening at any given time. And I'm going to show you all of those patterns right now. So right here, we started an uptrend. So we have our lower low here, right? And then we have a higher high somewhere around here, a higher low, higher high, higher low, and this is a higher high as well. And then right here, this is still a higher low, but then we have a lower low, and now we have a lower high. So from here, we went to an uptrend, downtrend, and then we go back into an uptrend again, right? So our lower low, lower high actually, higher low. Actually, that's a double top right there. And then we break to the downside, puts. So there's an uptrend. This here is going to be like our other thing that you'll see on charts, which is just consolidation. Like this is just going sideways. And then we'll have like our downtrends, so higher high, lower low, lower high, lower low, and so on and so forth. And then actually this is a good example here of consolidation. I wouldn't grab that wick, but if we grab like this much, actually, sorry, I take this back. This is consolidation here. And so if we were to grab this area here and tell ourselves like, I'm not trading anything in here once you realize that this is consolidating sideways. But then you can take it once it goes out of this area. Like you could have grabbed calls here from this consolidation area. Or if it breaks to the downside, you can take puts. I watched this live today. I guarantee you were not getting in on these wicks. They move so fast up and down. But on this white candle here, you could have grabbed calls. So that's just one more like area of technical analysis. And actually, when you have rectangle consolidation like this, that's also another measured move where you measure, price range. You measure from the bottom of the rectangle to the top of the rectangle. And so you can see this is 0.13%. And so I would expect a 0.13% move to the upside. Obviously, this today was news, so news is going to trump any technical analysis. This ripped way past, our 13%. But on a normal day where you don't have news affecting the stock like this, if you draw your measured movement from a rectangle consolidation, you will see like pretty close to 13% or a 0.13% move if we were to draw that out. And then if you have, a bigger rectangle, you're just going to have a bigger measure move to the upside or the downside. Right now I'm getting a little bit more complicated than I would like to be, at least for people that are new and starting. Really just look for your bull flags and bear flags. if you feel comfortable, you can draw rectangle consolidation and you can absolutely play it. And again, if you're not feeling comfortable, playing breaks of rectangle consolidation, or if you're not even feeling comfortable playing breaks of bull flags and bear flags, that's not a big deal. Just, start drawing them on your chart and watching the play out and build that confidence as you see it happening. Like, when you see that you drew a bear flag and it rips up, I don't even know what this is, 444.50, we'll call it, up to, it's like it's a 3.5 point move. So when you see a bear flag do a 3.5% or 3.5 point move, and you see this happening consistently, or hitting your fib levels consistently, you'll know, shoot, every time a bear flag happens or a bull flag happens, I can hop in that trade. I'm easily going to get my 40% here. And I can do this all day long over and over and over again. So that's what you want to start doing as a newer trader. But really step back and slow down. You don't have to rush into trades. I promise you, you'll find them, they'll come to you, and it'll work out. Again, a perfect example again today, like I was saying, I didn't take a trade until 9:30 today. And again, I made my 5.5%. So I'm not just speaking like, oh, be patient and wait. I practice it every day. Every day I'll sit here and stare at my screen because I'm waiting for a perfect entry so that, I have a good 70% chance that trade is going to go in my favor. Let me check Discord really quick. I think I got a couple questions. Okay, Hanson Ford asked if I can explain if these basic patterns happen on all time frames. And that's actually a really good question because it also covers another kind of topic I should cover, which is, you see me, I'm looking at the 3-minute time frame. This is pretty much where I always trade. But so if we find, like a bull flag in this case on the 3-minute time frame, this movement when it breaks, so you can see these are 3-minute candles. So this is 1, 2, 3, 4, 5 candles. So in 15 minutes went from here to here. So the lower the time frame, the shorter the trade will be. So like if I was to go down to the 1-minute time frame, I'm going to be in and out. I mean, like this is, you can see this bull flag doesn't even line up on the 1-minute time frame. This is actually going to be more of like a triangle pattern here. So it's something completely different even on a different time frame. But the patterns will show up, on different time frames. But like in this case, it ends up just being a different pattern that you would be playing. But yeah, they show up on every time frame. But so on a 1-minute time frame, my break of this triangle is generally going to be a much smaller, quicker move. But the difference between 1 minute and 3-minute isn't huge anyway. But so, a lot of like professional day traders will trade on the 5-minute time frame. And again, the pattern will look different, but you will find the same patterns, just on different time frames. So like for here, for example, when I see this, I would probably just ignore this wick and play this as a flag. And my pole's going to be, from here to here. Or sorry, not that wick, because I'm not including it. But there's my pole, there's my flag. I would take calls here. So anyway, the lower the time frame, the faster these plays are going to play out. A lot of times you'll see like, people on Twitter or whatever, they'll post like on the 1-day chart, I don't know. Let me see if I can see something really quick. Actually, let me go to the 1 hour chart. So here, it's a little sloppy, but we have a flag here. And if I grab my fibs, you know, this is the pole. So you can see finding this bear flag on a 1 day time or a 1 hour time frame, this took a lot longer to play out, right? And when it finally broke, I get the same measured move. I hit my 272 level and I hit my 618 level, but this took, you know, like a full, you know, from the break or from the initial break to the retest. So this is 1 hour, 2, 3, 4, 5. So it took 5 hours for this flag to play out. So yes, you will find the same patterns on higher time frames. They just take much longer to form. They take much longer to break. But when they do break, they make a much bigger measured move than a pattern that you might find on, you know, a 3-minute time frame or a 5-minute time frame. So this is going to be more for swing traders. I can't talk on swing trading very much. I am not a swing trader. I am like pretty much a 100% breakout option day trader. I'm normally in and out of trades within seconds. Sometimes at the most maybe 15 minutes, maybe 30 is really pushing it. If I'm in a trade for 30 minutes, I start to get really antsy because I don't like to be staring at one trade for that long. I start to get a little bit tired or whatever, and I don't like to take my eyes off of trades when they're happening, because I don't really use stop losses. I do everything manually through Active Trader. So really good question. Again, on the higher time frames, you're looking more at swing trades. This one here, I mean, if you caught this, like, it works out perfect that you're able to enter while the market's open and exit while the market's open. And then you can see, again, if you're using, you know, the POCs, like it literally came down and tapped the POC here. And so again, those levels are like so important to have on your charts. They really get respected consistently. And then the next thing that I would just cover is, after you've learned all of your technical analysis, all of your chart patterns, then I would start focusing on learning candlestick patterns. There's a lot more candlestick patterns. Like, these are just a few, actually. But you can do the same thing. Search for candlestick pattern cheat sheet on Google. If you like flashcards, there's a company called Wall Street Merch. I think it's wallstreetmerch.com, but you can just do a Google search for Wall Street Merch. And they actually sell flashcards with candlesticks on them, the percentage of time that they happen, and how often those patterns are correct when you find them on the chart. So they're actually, like, those flashcards are actually really cool. As I'm sure you can probably guess, I own them. And I love them. I reference them every once in a while because there's so many candlestick patterns. Like, I know this is really, like, I'm straining my eyes trying to see it. Like, this here is a long leg doji. There's so many different dojis, like it's almost impossible to remember all of them. So when I see a doji, like, I know this is a long leg doji, this is a doji. I think this is a northern doji, southern doji. And again, like, I don't even know. There's just too many of them. This here is an abandoned baby, I believe. Or that's a shooting star. Like, there's, like I said, there's so many candlestick patterns. You're going to have a fun time trying to memorize all of them. But what I really recommend is is focus on learning 1 or 2 a day and really memorizing them, and then try to find them on your charts as you're trading throughout the day. That way it'll like solidify it in your mind. And by the time you finish, learning all of your chart patterns and your candlestick patterns, like you'll be a pretty deadly trader. You combine it with just, basic TA. So like I was telling everybody, like a lot of people use a lot of indicators, and I'm not saying that's wrong. I'm just saying for me, like this is my charts. Like this is what I'm looking at when I'm trading. I do have a few secret weapons. And I mean, I don't mind showing them to you guys. I will show them, but like I glance at them just as a reference, and then I close them and I don't look at them again throughout the rest of the trading day, really, unless I happen to forget where a level is or something. But really, my deadliest weapon is going to be my POCs and my virgin POCs. And again, so like I said, through here, I have, 6 POCs, and you can see this just ends up being choppy consolidation. But if you're scalping, when you see like during the day price action leave this, you can grab quick scalps here. Unfortunately, most of the moves out of this consolidation area are happening after hours. So I can't really show you a good example, right here is a perfect example where we leave this 6x POC area here, like puts would have paid you massive. So when you have this stuff drawn on your chart, like it just makes it so easy to start entering trades. And you could have even got into this trade earlier because here we have, this kind of ugly looking bear flag, right? And I think I already charted this one before, but we'll do it again just for fun. Like this is an easy short. Not only are you leaving this 6x POC zone at the same time that you're crossing through this trend line, and then you retest, like some people will comfortably take a trade here. The safer entry is always going to be the retest of the trend line. And then you play it down to your 272 level, boom, you got paid. If you have more contracts, you can take it down to the 618 and then ultimately down to the 786 level. So this is a great move, if you happen to catch this. Oh yeah, I did completely chart this out. This is the 1 hour. Sorry, everybody. But so yeah, I mean, this is how I trade every day. I don't overcomplicate things. I draw my trend lines. I'll draw fib levels. I'm pretty much staring at the 3-minute chart because I'm a scalper. You want to make sure you watch volume. And again, highly recommend people read the book Volume Price Analysis by Anna Cooling. There's another book that I highly recommend, which is Getting Started in Technical Analysis by Jack D. Swagger. I think I pronounced his name correctly. Both very, very good books. Like if somebody asks me, I want to start trading, what do you recommend I start with? The first thing is going to be read Volume Price Analysis by Anna Cooling. The second thing is going to be reading Getting Started in Technical Analysis by Jack D. Swagger. And then the third thing would be to do this class with me on POCs, volume profile, and value area, and then go from there. And start the same thing I'm telling everybody right now. Look for those, start looking for your bull flags and bear flags and getting confident trading those bull flags and bear flags, and just slowly grow out your TA from there. That's really it for the class. Like, I don't know if it's possible to open up mics for people to ask questions, or if anybody has questions.
Give me a second.
Yeah, sure. I mean, I'll be happy to do like a Q&A if anybody does have questions.
As usual, I do. I mean, I'm on my 6th trade, so I trade a lot. On Friday, gone, I did 68 trades on the day with 40 profitable. 48 profitable, 20 not. So obviously that was good, but that Friday was nuts. So that's not normal.
That's awesome.
Now that entry, I said, "Oh, I'm in." That actually was a fake out. So you obviously moved away. It was a fake out, and now it's made a much bigger bear flag, which I've been scalping. I lost 2 trades and won 3, so I'm still up. And now I'm waiting to see what happens. So I'm not in right now.
I mean, that's awesome. Me personally, as a trader, I try to take less than 6 trades a day. I'm really shooting for like 1 to 3 trades. But again, I mean, I talked about, or you said you're not an option trader. You're trading
No,
stocks, correct?
this is well, not quite. I'm using, so because this is the Nasdaq, it's 20 times leverage. So
Okay.
I just have to balance how much I'm using at any time. If I use my whole
Okay.
account and it moves 5%, which at the moment seems to be really easy,
hmm
uh, then I'll blow my account. But you just manage the risk.
Yeah. So, so for me as a trader, as an option trader, I really try to limit myself to 6 trades in a day. And I I shoot for like really 1 to 2, maybe 3. I'd rather do just 3 trades, limit my trade costs, because I trade on TOS, so there are trading fees. But I'm also just looking for, I use appropriate sizes when I enter trades, and I use that 2-to-1 risk reward. And so I'm really just looking for that 5% every day. And a lot of times I can do that in 1 trade. Sometimes it'll take 2 or 3. But yeah.
So this is 7% so far.
I mean,
Um,
that's awesome. But like
but
to me
like
there.
it's how can I put it? There's lots of risk if
Mhm,
you're not really tight on your stop losses. So I know where to expect, where I know which way it can go. So basically, if this breaks
mhm,
up, I'll buy in again because the RSI is pretty low. There's other indicators that are saying basically it will eat up into maybe 50% Fib level of that
mhm.
main break it had, and
Yeah.
then at that point you'll close and then you'll see what happens again. So I
Yeah.
think the real takeaway is no matter which way you're playing it, how you're playing it, you have to be patient and let
Mhm,
the chart tell you where it's going to go next. Because there's
yeah.
always these trend lines.
Mhm,
You have all those different like wedges and like pennants and flags. To
mhm,
be honest, the way I learnt it is they don't really matter. All that matters is a triangle. If you can draw a triangle and it makes sense, so you're not cutting through loads of candles, you're going through wicks, like on top of the wicks, on top of the bodies, anything like that that looks neat. If you're
mhm.
just using a triangle pattern and it breaks either side, generally you've got something well drawn.
Yeah.
And you don't need to know what it's called. The fact is, it's a triangle because the stock market never gives you a uniform, like something in the book. Sometimes it does, but most of the time it's really messy. Like
Oh
that one
yeah.
you showed before that was really ugly, but look
Mhm.
at the trade you could have got.
Yeah, of
So
course. And
I
actually, you
think
bring up something really important for me to convey to people, which is don't get overly like into, oh, where do I draw this line, because technical analysis is an art. It's not an exact science. So even so, like my mentor, if I gave him a chart and said, hey, do your TA on this chart and I'm going to do my TA on this chart, I guarantee you our charts will look different. They'll look similar, but our lines are going to be different, and that doesn't matter. So don't like get overly hard on yourself, like, oh, I don't think this line's in the right place or whatever. It's really, it's really what you think it looks like, basically. That's the best way I can say it. Is it's an art. Draw your lines. You're going to cut through wicks, I guarantee you. You might cut through some candlesticks as well. But if you have a bunch of touches that is confirming, that your trend line is correct, you're good.
So the family should be capable of unmuting themselves and asking questions at this time.
Awesome. Anybody? Just in case there are no questions, I just want to say really quick, much love to everybody. I appreciate everybody showing up. I'm actually shocked that this is so big that we filled up this chat room and people weren't able to join. That's insane. But really, like, I appreciate everybody coming, and nothing but love for all of you, really. And I'm available. Like if you guys have questions outside of like right now, you can at me in the Discord or send me a DM like anytime, and I'll get to you. It sounds like we might have a question.